Hi everyone. Welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
In today's video, let's take a look at how Ray Dalio reflects on the 2008, the Great Financial Crisis. We will look at two lessons that Mr. Dalio shares that we can learn to be better investors, as we approach perhaps another recession in the coming months. According to Mr. Dalio, human nature and the basic elements of economics remain essentially the same over time. So, what happened in 2008 has happened many times before and likely to happen again. However, unlike recessions that occur more frequently, the dynamic that occurred in 2008 has happened less frequently in history and did not occur within most people's lifetimes. This is because investors, businessmen, and government officials did not previously experience the dynamic that happened in 2008. Most of them 1. Did not plan for it, 2. Considered it implausible, and 3. Didn't understand it. That, more than any other reason, is why so many of them were hurt in 2008. So, what can we learn from 2008 to be better prepared for the future? In other words, in 2008, those who built their strategies on the basis of what happened in their recent lifetimes did not comprehend what is happening and got hurt. While those who had a perspective of what happened in long ago times and faraway places, and why these things happened, did well. So, it is important to optimize your investment strategy not only for the period you understand well based on your recent experience, but also for how it would work in all circumstances, including circumstances that did not occur within the period that's your frame of reference. Lesson 1. Timeless and Universal Investment Process. Mr. Dalio talks about the importance of having a timeless and universal investment process. What he means by it is that one's investment process needs to have worked well in all countries and all time frames in order to continue to work as things change. Because it must be based on essential truths that include understanding of how things change over time. He believes if investors don't do this, their process will work until it inevitably doesn't work, until it blows up. Because things will inevitably change in ways that aren't understood and incorporated into the process. An example of what he means to broaden your perspective is to understand what happened in long ago times, such as in the 1930s, and faraway places, like Japan and Latin America. He suggests asking ourselves, what would it be like if we had another year, or another 2 years, like 2008? Because an examination of history shows that this is well within the realm of possibilities. Of course, nobody really knows what will happen, but we all need to consider the full range of possibilities. And make sure that our strategies make the worst-case scenarios tolerable, i.e., really control risk, and look for ways to maximize our opportunities. Lesson 2. Avoid systematic bias in your portfolio. According to Mr. Dalio, another reason so many investors did badly in 2008 was their asset allocation. They had big, concentrated exposures to assets and portfolios that do well when the economy does well, and badly when the economy does badly, and the economy did badly in 2008. The asset allocations were not diversified. They were, and still are, typically much more heavily concentrated in assets that do well in good times and badly during bad economic times. Examples include public equities, private equity, real estate, high-yielding debt, etc., compared to assets that do well in bad times such as treasury bonds. How did they get this way? It came about because of human nature. People are prone to do those things that worked in the past without thinking hard about why they worked or whether they will work in the future. In other words, investors are biased to invest in those assets that performed best during the timeframes that are in their frame of reference. Mr. Dalio believes that having huge biases is never logical. So, an important lesson of 2008 for most investors is to avoid having systemic biases in your portfolio, which means to restructure your portfolio so that it is less vulnerable to any one environment by having better diversification. It's interesting to note that even Treasury bonds have performed badly over the last 1-2 years under inflationary conditions. Looking at Bridgewater's current portfolio, we can see that they have shifted investments towards consumer staples, 27% of the portfolio, which does well during high inflation periods. This is to protect their portfolio against large drawdowns during this inflationary period.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors. Thanks for watching.